Money makes the world go round, but liquidity determines how fast it spins. Now, whether you're trading crypto, investing in stocks, or running a business, liquidity is the invisible force shaping our financial reality. Now, why does it matter? When liquidity is high, markets boom, businesses expand, and investors thrive. But when liquidity dries up, we get recessions, crashes, and financial panic. So where does global liquidity stand today? What does it mean for you? What does it mean for us? Now, number one, what is liquidity? Liquidity is the ease with which assets can be bought or sold without causing a major price change. It's what allows businesses to get loans, investors to move money, and markets to function smoothly, okay? That's how liquidity works in general terms. Now, there's three different types of liquidity. There's market liquidity, which is how easily assets can be traded. And we're talking stocks, crypto, real estate, etc. Okay. Then we have funding liquidity, which is access to credit and capital for businesses and individuals. And then we have global liquidity, which is the overall availability of money across economies in the world. Now, let's go into it a little bit more. What drives global liquidity? When central banks like the Federal Reserve cut interest rate and engage in quantitative easing, which is printing money, liquidity floods the system. When they raise rates and engage in quantitative tightening, liquidity contracts, which makes credit more expensive and markets more volatile. Now, as it specifically relates to banking and credit markets, if banks tighten lending standards, businesses struggle to grow and consumers cut spending. This creates a domino effect across economies. For example, during a credit crunch, small business loan approvals can plummet. Now, unlike traditional finance, crypto operates 24/7 with global liquidity pools, stable coins like USDC, USDT, DeFi lending platform like Aave and Compound. Tokenized assets are reshaping liquidity dynamics outside of government control. However, crypto markets are also known for extreme volatility and the risk of hacks, rug pulls, they all exist. So you have to be educated and be very careful. Now, in terms of DeFi versus traditional liquidity, traditional finance relies on central banks and commercial lenders to control liquidity through interest rates and credit issuance. In contrast, DeFi uses automated market makers and smart contracts to create liquidity pools. What this does is it eliminates the middleman, but also introduces risks like impermanent loss and liquidity crunches when large withdrawals occur. This is something on the DeFi edge that you have to be educated with and be experienced with to know exactly what I'm talking about. Now, let's go back and talk about the impact of tariffs on global liquidity. The Trump administration imposed significant tariffs on imports from Canada, Mexico, and China. And these measures aim to address trade imbalances and protect domestic industries. There are, however, some economic consequences. You get increased costs. For example, tariffs on imported items like steel and aluminum will significantly increase the production costs for automotive industries. Companies like Ford, General Motors. This is an inflationary pressure, and it can reduce disposable income and dampen consumer spending because that gets passed down to the consumer. Then we have supply chain disruptions. The companies reliant on global supply chains face increased costs and operational challenges, which could potentially lead to liquidity crunches as they struggle to manage higher expenses. For instance, electronic manufacturers relying on components from China can face significant delays and cost increases, which of course comes back to the consumer. Then we have market uncertainty. Tariffs creates uncertainty in financial markets, leading to increased volatility and risk aversion among investors. This can result in reduced investment and tighter liquidity conditions, which can affect the volatility of assets. Now, tariffs can also impact current liquidity by influencing capital flows and exchange rates. If a country facing tariffs experiences a slowdown in exports, its currency may weaken, leading to capital flight. On the other hand, central banks may intervene by adjusting interest rates or foreign exchange reserves, further affecting global liquidity. Now, that's on a deep end of the spectrum, but these are ripple effects, okay? You can have retaliatory tariffs from affected countries, and it escalates trade tensions, which of course further disrupts global trade flows and economic stability. This type of tit-for-tat scenario can lead to a contraction in global liquidity as international trade can diminish. Now, it's important to note that tariffs are also used to protect domestic industries and to apply pressure on other nations to change trade practices. That's the goal of these tariffs. At least that's what I've heard from the Trump administration. I've heard them say the U.S. has been taking advantage for too long. So now, how does this affect us? As investors, stock and crypto markets thrive on liquidity. When it dries up, volatility spikes and asset prices drop. You might see more sudden drops in your portfolio. Boy, telling you, I've seen it in mine. For businesses, it's harder. Access to credit means slower growth. Hiring freezes, cutbacks. Small business owners may struggle to secure loans for expansion, and just for everyday people like you and myself, we have higher interest rates, which leads to more expensive loans, mortgages, and credit card debt. Monthly payments can increase significantly, but everything is speculation, but this is historical. But anything can happen. So my question is, what's next? Your question is, what's next? Let's say if central banks, because this is the economy we live in, loosen policy, we could see a flood of liquidity driving risk assets higher. If they remain tight, expect more volatility and slow economic growth. Key indicators to watch include central bank announcements, inflation data, and bond yields. Crypto and decentralized finance offers the alternative. But the question is, can crypto scale fast enough to counter traditional liquidity cycles? And will it be able to handle the volatility that it is known for, making it a part of the reserve as the U.S. has done, will spur other countries to do the same. But let me just close it out. Liquidity is the fuel of the financial system. Understanding it gives us an edge. It doesn't matter if you're investing, if you're running a business, or you're just managing your money. So it's important that we pay attention and we learn about it. Now, let me ask you a question. What do you think? Will global liquidity expand or tighten further? Drop your thoughts in the comments. Don't forget to like, subscribe, and share. It's your boy. Catch y'all on the next one.